If you have questions about foreign taxes, I think this video will answer most of your questions, because these are the key points that are central to foreign earned income tax benefits. There are 4 short videos in this series about foreign earned income tax benefits. They start out with just the basics, and as you move through them, I think you may find things that are in here that you either don't know or don't fully understand, and these are things that you need to know. A U.S. citizen or resident alien is required to report income regardless of what country or territory they live in. Some people who are living abroad may not be taking advantage of tax benefits they are eligible for. For example, in 2009, a U.S. citizen living abroad may have been able to take advantage of a foreign earned income tax exclusion in the amount of $91,400. That is the amount of money that the taxpayer would be allowed to exclude from taxable income that is reported to the IRS. Also, you may have been entitled to a housing exclusion or housing deduction. You may also have been able to take advantage of meals and lodging that was provided by your employer. I want to explain to you now about how these tax benefits work and point out some of the traps, because a lot of taxpayers are not aware of these benefits or do not fully understand critical aspects about how they work. So I want to begin by talking about the foreign earned income exclusion, the foreign housing exclusion, and the foreign housing deduction. If you are working abroad, or if you are going to work abroad, the first thing you want to do is determine if you are eligible for foreign tax benefits. If you are a U.S. citizen who is a resident of a foreign country for 1 full tax year, then you qualify because of your residency status. A tax year under the residency test for most taxpayers is 12 full months, beginning on January 1 and ending December 31. If you are a resident alien and a citizen of a treaty country, that is, a country the U.S. has a treaty with regarding taxability of earnings, which is, there are approximately 13 of these countries, and you are a bona fide resident of a foreign country, then you qualify. If you can't meet the residency requirement, then you may be able to meet the physical presence test. This test states that as long as you are physically present in a foreign country at least 330 full days, then you qualify for the foreign tax benefits. That would be the earned income exclusion, housing exclusion, and housing deduction. The 330 days must be within 12 consecutive months that include 1 tax year, but the days do not have to be consecutive. I will show you examples of the tax year requirements, because they are quite different depending upon whether you are qualifying under the residency test or the physical presence test, and because there is a lot of confusion about how the timing requirements work. In the next video, I will explain in more detail by giving you some examples to show you how the rules would actually be applied to specific situations. The examples, I believe, will help to clear up most of your questions and clear up misunderstandings about how the two tests work. because they are different. And then I'll also get into some issues that you need to be aware of to help keep you from getting disqualified.